And from one final question, from a fund management point of view, if you see the last 9 years, I know you haven't been with the company for 9 years, but
Yeah.
I'm sure you have access to all the data. From a pure fund
Yeah.
management point, since all the options, different asset classes, pure equity, pure debt are all available within NPS,
Yeah.
how has the
Yeah.
performance been vis-a-vis, say, the benchmark mutual fund kind of performance? Has it been pretty similar? Of course, no two fund managers will ever perform the same, but
Right.
just to get a sense of the performance plus the cost benefit that you talked about.
So I think, firstly, if you look at the since inception performance of the funds that have been around for a long period of time, there are 7 fund managers that have spent almost anywhere in the region of 9 to 10 years. And we will complete 10 years in August 2023. So we would have completed 10 years of existence at that point of time. On equity, as you rightly pointed out, the returns have been in the range of compounded between 12 and 13% per annum. In our case, it's, I think, 12.7%, the last data that I recollect, which is the most recent data that I recollect. So around 12.7% compounded, which is actually quite compelling. In fact, this is possibly the only actively managed product where NPS Trust, which is really the trustee or the custodian of all the assets that are held by the subscribers, it's held in trust with the NPS Trust, and NPS Trust is an intermediary of the PFRDA, right? The NPS Trust, which is charged with the responsibility of overseeing of course, one is holding the custody of all the assets that are held by invested by the various pension fund managers. It is also charged with the responsibility of overseeing the investment management function of all the pension fund managers. So both the PFRDA and the NPS Trust actually monitor our performance on a quarterly basis. Of course, we do not interfere in the fund management, per se, because that's entirely, left to the pension fund manager. But there are very clear guardrails that have been set, very clear boundaries that have been set in terms of what you can invest in. There are, of course, stock level, sector level, promoter level, and so on and so forth, rules that exist. And these have been defined by the PFRDA, both for equity as well as for corporate bonds, and government securities are government securities. So there are very clear boundaries that have been defined, and within these boundaries, the industry has performed exceptionally well, in my opinion. And the fact that the cost advantage of close to, and if you were to just take a hybrid fund, because let's say a 75-25, typically a hybrid fund will cost you a total expense ratio of, I would suspect, between 1.5 and 1.75% per annum. Vis-a-vis that, we're talking about less than 10 bits, right? So you're saving 1.6, 1.7, 1.5 to 1.6% potentially by investing in a national pension scheme. And I'm not for a moment suggesting that, and all these products have their, space in the portfolio. You need to have, every product has a place in the portfolio, but I'm just purely from a cost perspective comparing the two. Is significantly cheaper, and therefore over long periods of time it adds significantly to and in fact the comparison of performance that we do on a quarterly basis, the NPS Trust during its reviews, when it does it, actually one of the comparisons that we do is against the family of large cap mutual funds. And I must tell you that this looked at very closely, and for various time horizons, if you look at the overall industry, it's done better than large cap mutual funds for different tenures as well. So I think overall performance has been fairly rock solid, not just in equity, but also in corporate bonds and the government securities portfolio. If you look at the C and the G category that I was referring to earlier as well, since inception, returns are upwards of 8.5-9% per annum return. So which I think is very, very, very attractive, right? So across all the 3 categories, the returns have actually been very, very encouraging. And I think investors must take advantage of the fact that, here's a low cost, tax advantaged, reasonably well performing vehicle that's available. And, one of the things that, Vivek, I just want to use this opportunity to also bust some myths around, people saying that, there's a, if product mein dalo to, paisa phas jata hai, you can't get out. And my view is that that's possibly the biggest positive feature about this product, right? Because the reality is that in a market-linked product, and especially in equity as a vehicle, equity by its very nature is a volatile asset class, right? So it's a feature, not a bug, right? So volatility is inbuilt into equity as an asset class. And all of us are human beings. We react when there is a so-called market meltdown, when there is a lot of noise around us. We tend to get out, get in, get out, get in, and therefore we lose out on returns in the long term. This product doesn't allow you to get out, right? Which in itself takes care of the behavioral bias that is exhibited by most individuals. And therefore you have no choice but to stay invested, and therefore you are willy-nilly going to make double-digit return in my view. And of course,
Yes.
and that's by far the biggest positive feature about this product, in my opinion. And I think it's not very well understood. And I'm happy that you're doing these sessions through your Money Paathshaala program.
I think because you are low cost, I think the flip side of it is that not too many people want to sell your product. So I guess we need to make people aware of it. Thank you very much, Sriram. It's been wonderful talking to you. It's such a vast subject. I'm going to keep coming back to you every month or couple of months and keep this conversation alive. Thank you for taking time out. Thank you.
Thank you. Thank you very much, Vivek. Thank you.